Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, January 20th, 5:25 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market, we are in an uptrend, still a cautious uptrend as we're below the 200-day moving average. Well, not as many below the 200-day moving average as we were yesterday, as you can see over here on the trend gauge. Leaders, bullish. Challenging week for the market, but only three leaders came off, and arguably it could have only been two. I cut one because of really bad relative strength. But the leaders held up above the 21 while the indices struggled. So we're in uptrend mode there. Short-term 21-day exponential moving average. We had one close below yesterday in the S&P, and it regained it today in a very bullish day. Need two closes above to get rid of the yellow sub arrow. Medium term, same thing yesterday. Closed below the 50, reclaimed it today with a very nice day. And long term, still neutral. S&P 500 basically closed right on, well, 3 points above the 200-day moving average. NASDAQ 100 still the laggard, although showing some relative strength over the last 2 weeks, and that can really propel the market higher if that continues. So what just happened today? Absolute best case weekly close for the bulls. G6, this is our 6 ETF growth proxy, up 2.34%, S&P 500 up 1.9, NASDAQ 100 up 2.7, Dow up 1%, mid-caps up 1.65, Russell 2000 up 1.7, Global Diversified 60/40 up 0.73, bonds held this back, in-house GROTECTION up 0.94%. Let's dive right into it. So here is the S&P 500, and let's go to the 60-minute chart. And I meant so let's step back a bit. Let's go to the 5-minute chart here, and this was Wednesday. We had a decent day Tuesday. It was a healthy consolidation after a nice close to the prior week. We gapped up, we held it for about a half an hour, and then we just started selling off out of the blue. A little bit of a bounce, selling off, and then another gap down on Thursday. But we put in a bottom at this key level that I've have been referencing. We held that level overnight. Small gap up, tried to sell it off early, but ended up being a trend up day. Very strong afternoon as short covering kicked in. I'm sure some people got bearish based on what happened on Wednesday and Thursday with the close below the 50, below the 21, and the fail at the 200-day moving average. But let's go to the 60-minute chart here, and you can see this key level that we wanted to hold, this 3870-ish to 3890. Touched it on Thursday, held it, didn't touch it overnight, and a really nice day on Friday. Now, we haven't gotten back what we gave up starting on Wednesday, but certainly a great way to close the week for the bulls. Weekly closes hold more weight than normal because a lot of funds tend to position themselves the way they want to be for the following week by making buys or sells on Friday. That's why you see for bear markets normally close near the bottom of the range for the week. Bull markets close near the top of the range. And it's just a function of what's going on from a standpoint of how the funds are positioning themselves. Uh, Upper range close for the week, also a good sign. So um, undoing a lot of the damage that was done Wednesday and Thursday, and getting right back into this 200-day moving average. If you look on the weekly chart on the S&P, we closed 0.7% above the 40 week. So not quite that 1% close that I like to reference. We did close 1.1% last week, undercut it, reclaimed it again, but didn't make a higher high this week. Actually, we did make a higher high, but we sold off. We made the higher high on Tuesday after the holiday. Couldn't reclaim it on Wednesday, sold off, but definitely a good close for the Bulls, another goal line stand, if you will. And in the scheme of percentage retraces, it was pretty much acceptable. Certainly caused some nervousness. I know in-house, Dan mentioned on Thursday he got so many client calls. He said we've got to be near a bottom. I took so many calls today from nervous people. That's the title of last night's newsletter was "Will the market wear you out or scare you out?" So good response by the bulls. Another good thing to see is that the stochastic came off of overbought, headed lower, but hooked back up today with the action. So this is, I consider to be neutral now. It hasn't decisively gotten back above the moving average, but sometimes you don't have to come off of overbought and go all the way back down to oversold. You can see it happened here. Really, that's the only example on this chart here. So normally the trend continues, but in this case, another feather in the cap for the bulls with the goal line stand. How many analogies can I throw out there? Or cliches, not analogies. Let, let's go to what has me most excited, and that's the relative strength on the NASDAQ 100. If these big cap stocks are going to move in the NASDAQ 100, they're going to take the indexes higher. They got absolutely crushed in 2022. They lagged badly. Everybody was talking about the equal weight NASDAQ, the equal weight NASDAQ. Well, it lagged again today, up to nicely up 2.3%, but the NASDAQ 100 up 2.7%. NASDAQ 100 equal weight undercut but reclaimed the 200-day moving average. It's trending higher also relative to the S&P, but let's see what the numbers were on the week. The QQEW negative on the week by 0.32%, and the NASDAQ 100 with the heavy weightings of the big caps up 0.61%. So the NASDAQ 100 just got tired of everybody talking bad about it and saying how nice the equal weight was, but enough of that. Let's get to the Dow Jones Industrial Average, which continues to lag because value sectors continue to lag. You can see it's below the 8, the 21, and the 50. It led for quite a while, so it's still firmly above the 21. You can see the lack of relative strength over the last 3 weeks here on the NASDAQ, on the Dow. I talked about on the podcast, which is available now on YouTube. It'll the email alert will go out tomorrow morning. How we were positioned for the Dow to outperform going into the beginning of the year, but just looking at the evidence at hand, we quickly were re-informed by the market that that's not what's leading. So we don't own Dow anymore. We don't own SDY anymore, which was a dividend ETF, which also has been lagging. But high beta is beating low volatility badly so far this year, and that's good for what we do at Revere, which is keep an eye on growth stocks. They're the ones that really take off in a healthy market. Let's go to mid caps. We bought the mid cap index today on the bounce off the 21. Good stuff here. Again, the hook down from oversold, but the hook back up based on the action today. This is the best acting of the index. As you can see, the relative strength for 4 weeks there. IWM, remember mid caps. Nobody talks about them enough, but we sure do. We treat them, we talk about them as much. We don't weight them equally, but we talk about it and reference it as much as any of the other indexes. And the reason is because that's the incubator for the next big leaders. You graduate, you start as a small cap, you graduate into one of the small cap indexes, then you go to the mid cap index with your goal making it into the S&P if the sales growth and the revenue growth and the earnings growth continues. So that's why we're always keeping an eye on MDY. Here you can see small caps coming back, bouncing at the 200-day moving average, the 21 and the 50, trying to get back above the 200. Also a bullish sign there. And again, the hook down and hook back up on the stochastic. Let's go quickly to RSP, the equal weighted S&P, up 1.7%, slightly below the full weighted, the market cap weighted S&P. It never broke below the 50-day moving average, bounced nicely on it. Same thing with the stochastic hookup there. Let's go to the dollar, which started out strong today and faded as the day went along, and this coincided as the dollar weakens. Normally what you see, this is the inverse correlation we've seen for a while. You see the market strengthening, and that certainly is what we saw today. Let's go to the VIX. Is the VIX broken? I don't think so. Trending back below 20. It's been pretty much trending, consolidated, but trending for the most part below this declining 21-day and 50-day moving average. Let's get to bonds. We talked about bonds quite a bit today in the podcast also. So the broad bond index (BND) pulled back today. Price down. That means yields were up. Sitting on the 200-day moving average. LQD, which is corporate bonds, also pulled back to the 110 level above all the key moving averages. Junk bonds, any fear in the credit markets? No, junk bonds actually up today. Remember, they move more in tandem with stocks than bonds do because it's a reflection. If stocks are doing well, it's a reflection that these companies that put out these high yield slash junk bonds can make their coupon payments, their interest rate payments without any problem. So good stuff there on JNK. Finally, TLT. This is the 30-year pulled back, which means the yield was higher. Let's go to the yield on the 30-year TYX. Yield up, still trending below the 21-day moving average, and the yield on the 10-year TNX also higher today into the declining 8 EMA. Finally, let's get to Bitcoin, BITO. The only trustworthy I would say Bitcoin and Ethereum are the only trustworthy cryptos. Higher highs today, up 5.82%. Can you finally see on a daily chart that it's making progress? Yes, you can. Right into this declining 200-day moving average. So very interesting there. It's been below it, well, as long as it's been alive, because it's a relatively new product. But we'll see what happens if technical analysis applies or if it blows right through it. Normally, into a downtrending moving average, the first time is a rejection. We'll see what happens. Let's go to gold. GLD dollar down today, but gold down also, down a third of a percent inside day, still very strong. Silver, on the other hand, was higher, not by much, but it's still in this 4-week, for almost 5-week consolidation now, very tight. We'll be buying this if it breaks out of this consolidation. And GDX, gold stocks consolidating nicely for about 2 weeks now. Haven't even touched the 21 during this 2-week pullback. Best place for an entry would have been off of 30 here on 1.5. Hasn't gotten away. $2.42 above that 30 level, trending higher above the 21-day moving average. So those are the major indexes. Let's get to the tail of the tape and then the 21 over 21 list. Stochastics went from negative to neutral with the hook back up today. We want to see that sustained. VIX, as I said, down 3%. Fear and greed ticked up 6 to 59. Bull case now outweighing the bear case, still from the standpoint that we're back above the 21 with only one close below it on the S&P, and the NASDAQ 100 did not break the 21 on that pullback. A little bit of news. Fed head Waller talked today, was very hawkish. Market didn't care at all. Day count went from 2 down to up 1, and first day back above the 8 EMA and the 21 EMA. Expectations after the recent weakness were neutral, but we needed to stay above 38.70. I wasn't sure which way this would go. Very positive trend day up with a close at the highs. As far as the support resistance levels go, S&P reclaimed 3 levels, still below this 4,007 resistance level. NASDAQ 100 started the day in here, broke above the resistance level as it's been outperforming lately. Trend update, as I mentioned, all 11 sectors up higher today. Uh, Higher but lagging were staples, utilities, and healthcare. In fact, they were red for most of the day until the strength really kicked in late afternoon. K-Web strong, software strong, uranium strong, banks strong. Well, KBE was strong. Some of the big banks weren't. Goldman Sachs got hammered on an investigation into their retail practices, and JP Morgan didn't do very well either. We're still holding on to that as it held the 50-day moving average. Dollar started out the day higher, gave it up lower. That certainly propelled stocks. Bond prices down, meaning yields up, and gold, the only other major thing I could find, that was down. Focus list will be the 21 over 21. We'll go over that momentarily. In-house, right out of the bat today with the continued strength, we sold our QID hedge, added to MDY, the mid-cap index, bought Schlumberger, and we added additionally to our XBI biotech ETF and QLD uh, leveraged NASDAQ 100 ETF, taking our adjusted beta from 0.42 up to 0.62. If I'm above the 21 EMA, I want to have a beta of about 0.6. That's the target. If the market's going higher, we got to stay in sync with it. Started the week with a beta of 0.7, went as low as 0.42 is where we bottomed out yesterday after some stops getting hit and 2 days of weakness, really 3 days of weakness, but the first day I considered healthy before Wednesday slapped us in the head. And but back up to 0.62. Bottom line, absolutely best case weekly close scenario for the bulls, reclaiming all three key moving averages, the 21, the 50, and the 200. You can see here where we started the day yesterday. We got back above the 21, the 150 day, the 50 day, this 39.50 area that was prior support and resistance, and the 200-day moving average. So 5 significant levels in one day. Certainly good stuff for the bulls. Now looking above, we've got 39.99 and 4,007. That's the target that we'll set our eyes on next week. And in addition, the 200-day moving average, this is still dropping by 3 points a day. We want to put some distance between the price of the S&P and that 200-day moving average. So that's the tail of the tape. Let's now get to the 21 over 21. And as always, we start off with what we dropped. JP Morgan breaking below the 21 after a really nice day last Friday. We bought it. We're down, sold half the position. We're down 5%, I think, on the remaining half position. It's still holding the 50-day moving average. Schwab, SCHW, reported earnings, not a good reaction, and then double downgrades on Thursday really took it below, and this stock is now officially broken. JD, this is the one that I could have kept, but I don't want anything on the 21 over 21 list that's showing relative weakness like this. A lot of Chinese stocks acting well, even the China ETFs, they all look better than this. This is a leaders list, not a laggard list. So although it held on to the 21, or I should say reclaimed it by the end of the week, we said goodbye to it. And the fourth one was Halliburton. Uh, Nothing wrong with Halliburton. I said nothing wrong with Halliburton. Are my charts holding up here now? And we're back. Halliburton, nothing wrong with it. Harsh 2-day pullback along with the market after breaking out. But we bought Schlumberger today on its earnings reaction. Halliburton reports next week, so we went with the one that had the earnings reaction. And although it was initially very positive, Schlumberger, we'll go right into that as the first member of the 21 over 21, the updated 21 over 21. And you can see very similar charts. Okay, we're having problems with the charts here, and we're back here. Schlumberger here, basically the same chart as Halliburton, but did report earnings. Initial gap up, pulled back right to the pivot, undercut, reclaimed the ADMA. Oil services has been leading, led by Schlumberger and Halliburton. Good low risk entry for Schlumberger. Let's get into the rest of the 21 over 21. Mercado Libre, oldie but a goodie, making a comeback. Former leader, well off the highs. But some big volume came into this late last week, and it consolidated very nicely near the top of this flat base. We want to see a little bit more consolidation, but a move out of here on big volume. This is a nice big liquid stock, and we're keeping a close eye on it. Second ad was First Solar. Uh, we now the solars yesterday, earlier this week, they had a bad week, but you want to keep your eye on the industry group that was the first one out of the gate when market starts getting strong, and that's what the solars were. The leader of the solars was First Solar, pulled back hard for 3 days, bounced at the 21-day today. This is actually an extremely low risk entry, and it's in the top 5 of our list to get back into next week. Don't want to buy extended, nice pullback. And note, although it's a harsh pullback, the volume on all 3 days was lighter than the 2 big up day volume when this first started kicking off the rally on January 6th when it reclaimed the moving averages. So First Solar, definitely the solar leaders. And as I said, when an industry group is first out of the gate, you want to keep your eye on it. They're allowed to pull back. It was harder than a little bit more difficult pullback than normal. I'm sure a lot of people got shaken out, but um, low risk entry on that. Netflix reported earnings, doubled their expected subscribers. Down 91% is awful, obviously, but the reaction is what is important. Now, you can see over here with these little green triangles pointing higher, that means that these earnings estimates have been upgraded based on the results that they reported last night. And they cleared this recent 336.65 resistance from 2 weeks ago. Big volume, 195%. This is a big stock. We owned it, got stopped out of it on this gap down back here after they said their advertising for their free platform wasn't going as well as expected, but certainly a good reaction today. Big gaps up on volume. We certainly want to keep our eye on it. And Schlumberger we already talked about. So now these 17 are carryover tickers from last week. 4-day pullback on biotech, bounced right where it needed to at the pivot around this 84, 85 area. When you see big volume like this, it's not as concerning on an ETF as it is for a stock, because ETFs are created and destroyed according to demand. So if a bunch of people were selling, that's fine. The volume's going to be higher. I don't know what the net was for how many people were in XBI relative to after this happens, but you have to worry as much about heavy selling on ETFs as you do on individual stocks. And I just see this as a nice handle in this big long cup that has been formed now. Revance, higher highs, big move up here, pulled back. This is acting perfectly compared to the model that we use for inflection points or earnings gaps. Never even touched the 8 on the move back, and then busted out today. AEHR, we own this. Wish I owned more of it, but it is on the thin side. Up 15% today, breaking out above 30. Good sign for growth stocks. Las Vegas Sands continuing to act well. Nike continuing to act well. Again, Nike, one close below the 8 since its earnings report. Um, Acting great. Can't complain about anything with that. PIC continues to act well. Great acting ETF, consolidated for 5 days now. Ulta, uh, 1 day below the 8, reclaimed it today. GE pulling back finally after this really strong run up. Crocs, uh, 2-day pullback after higher highs, normal, sitting on the ADMA. Caterpillar, pulling back after this, and 2 days off of the 21, just what you want it to do. Now, a little bit higher sell-off volume than I would like to see, because this is a stock, not an ETF, so mild concern there, but should hold yesterday's lows. Lennar bounced at the 21 today. MDGL continuing this tight Very tight action along the ADMA with volume trending lower. Looks like it's coiling for a breakout. NVO after this sell-off and 2 weeks ago and a move below the 21 just absolutely reclaimed it with strength to close at highs. Shift for payments, 2-day ugly pullback, reclaimed a lot of it today. GDX looking to get into back into this after this really nice 2-week consolidation as the moving averages are catching up to it. Five below, bounced at the 21 today the way it needed to, and Boeing might have its first visit. 5 straight down days for Boeing, but look at the volume. This is picture perfect on a pullback. This is exactly what you want to see. Now, Boeing did hit the pivot plus 20% profit taking area, but this isn't a traditional can slim stock. It's more of a turnaround than a growth story. But look at the volume drying up there. You see, I've got my alert to possibly get back into this. It's actually below where we sold out around 208 ish if my memory serves me correctly, and down 5 straight days, but down on bone dry volume. And that's going to wrap it. That's your 21 over 21 list. As always, love to hear from you. The email is don@revereasset.com. The phone is 855 Real Wealth. That's 855 732 5932. So I didn't give the public service announcement, which tells what we do at Revere. We are active managers. And we our exposure to the market is dictated by the overall health of the market, and the overall health of the market, especially when we're above or below this black line, the 200-day moving average. I can't believe I almost closed this video without showing my favorite chart. Hopefully we get to rally mode and we can retire this chart for a while, as there's no need to reference it in an uptrend except for maybe once a week just for old time's sake. But this is what we avoid at Revere. These are the last 13 bear markets. Our max drawdown was over 12% versus 27.5% last year. Capital protection is what we hang our hats on. Risk management, downside protection. Because if you take care of the downside, the returns take care of themselves when we get back to a bullish market. And boy, wouldn't we all like to see a bullish market. So again, the email is don@revereasset.com. The phone 855 Real Wealth. That's 855 732 5932. My partner, Danny Stewart, if you're interested in becoming a client, would love to discuss it with you. And that's going to wrap it. As always, remember, it's not how much you make in the market, it's how much of that you can keep. That's our motto here at Revere. It was a tough week. I'm really glad to see the week close the way it did. Certainly good stuff for bulls. Move up, digestion, intraday, strong close, recapturing levels. Not quite back, obviously, to the 14, 40, 15 level that we were uh, earlier in the week, but certainly good stuff nonetheless. So, wrapping up the week ending January 20th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.